Hi, I'm Scott Walker with Wealthcare Investments and Insurance. I would like to take a few moments to discuss with you traditional IRAs. IRA stands for Individual Retirement Account or Individual Retirement Arrangement. Traditional IRAs are qualified accounts, so there are IRS guidelines regarding the contributions and distributions. Now, traditional IRA money is pre-taxed or tax sheltered. The contributed money has never been taxed. You can make personal contributions into your traditional IRA, and you can also roll over money from an employer retirement plan into your traditional IRA and still maintain that qualified status on the money. When you withdraw or distribute money from your traditional IRA, all of the money, both the money that was contributed and the growth, is considered taxable income. Now, when you contribute money into your traditional IRA, you may be able to deduct all or some of the amount on your tax return. This depends on three things: your tax filing status, adjusted gross income, and whether or not you are eligible for an employer retirement plan. Also, there are annual contribution limits. In 2020, the maximum you can contribute into your traditional IRA is $6,000 if you are under age 50. If you are 50 or older, you can contribute up to $7,000 into your traditional IRA. Excessive contributions may result in an excise tax. However, you might be able to carry the contributions over to the following tax year. This is why it's so critical to work with a tax professional when making contributions into a traditional IRA. Now, withdrawing money from a traditional IRA prior to age 59 and a half is considered an early distribution, and this may result in a 10% tax penalty in addition to the normal federal and or state income taxes. There are exceptions to this rule, which can be found in IRS Publication 590B. Traditional IRAs are subject to required minimum distributions, or RMDs. Starting at age 72, you are required to take distributions from your traditional IRA regardless of whether or not you need the money. There is an IRS table that determines the percentage you have to take each year depending on your age, and that withdrawal percentage increases as you get older. Failure to take your RMD may result in a 50% tax penalty in addition to normal income taxes. Now remember that all distributions from traditional IRAs are considered taxable income. So this can not only affect your tax bracket, but if you are retired and you're receiving Social Security, this could affect the amount of Social Security income that is also subject to taxation. Now, I've only been able to touch on the very basics of traditional IRAs. There are lots of rules. There are exceptions to the rules, and those rules are always changing. So I can never stress enough the importance of working with a tax professional and an investment professional before making decisions that could hurt you in the future. As always, we would be happy to meet with you in person, virtually, or by phone. Please feel free to reach out to us. Our contact information is on the screen. Thanks for watching.